Let's get to the advisory though, and the government's proposed Division 296 changes sparking debate about whether super is still the right place to hold significant wealth. Let's join personal finance expert and founder of the Inner Money Journey, Betsy Westcott. Betsy, always good to see you. Let's just take a step back and remind us of these changes and what we're expecting to see here.
Yeah, so just to recap, I'm sure we're all across it, but basically the government announced that they were going to make a few changes around the tax concessions applicable to those that have total superannuation balances in excess of $3 million at the end of the financial year. So if you have a balance above $3 million, the earnings will be taxed at 30%, which is double the current rate, which is 15%. And then for those that have balances in excess of 10 million, then the earnings above that will be taxed at a further 40%. So let's just remember that it is yet to be legislated, but given the state of Parliament, it's pretty much a done deal. And it's likely to commence as of the 1st of July 2026, so in the new financial year. I think the two big wins here, though, were that they have agreed to index these thresholds with CPI inflation so that they increase in value over time and really maintain that integrity of the policy, which is to tax those really high balances that have been making the most of this very juicy, low tax super environment for wealth creation, but not penalise the average Australian who's just trying to build up retirement savings to have a dignified retirement. The other big win is that they got rid of that very silly idea of taxing unrealised gains. So that was something that they had proposed. It got a lot of criticism, rightly so, and that's now been excluded. You will only be taxed on the realised earnings. So I'm so glad they came to the table with that one.
Yeah, I think a lot of people feeling a lot more relieved about some of these changes. But those that have the larger balances, do you think we're going to see money flowing out of super, or is it still going to be the place to try and build your wealth?
Look, the whole purpose of super is to enable Australians to have a dignified, self-funded retirement. And so for the average Australian, super is still going to be the most effective long-term wealth creation vehicle with those, offering that concessional tax and those really strong compounding benefits. And for those that have those large balances, though, if they're still in the accumulation phase where they're building up their retirement savings, there's probably not a lot they can do to move money out of super. So the strategy for them may be to really reconsider as to whether they want to keep contributing to their super or look at other vehicles in which to build wealth as well. For those that are in that retirement phase already, well then yes, they may be going, should I keep this money here? If and then also looking at the tax that applies when people inherit their super balances. Does it still make sense for them to keep it there? So I think some may look to shift future investments outside of super, consider things like trusts. Trusts are great for intergenerational wealth building, but then you have the things that income has to be distributed every year. They can be complex to set up. Others may consider companies, and they've got a fairly attractive tax environment, 25 to 30% depending on the structure. You can withhold earnings and accumulate wealth in them, but again, they're complex to set up and administer. So, making sure that you pick the right vehicle based on your goals, the tax outcomes, as well as your estate planning is going to be really important. So what I think we're going to see here is a trend towards diversification, balancing wealth between super and those external vehicles to achieve the right financial outcomes for you and for your family as well.
So Betsy, what are some of the key factors to weigh up then when people are looking at some of those options that you mentioned, super, trust, company or personal ownership for the purpose of wealth creation?
Yeah, I think there's 5 things you want to consider, and then there's a number of people that you want to consult. So things to consider include the purpose, like what's the money for? Is it for your retirement income? Are you trying to build intergenerational wealth? Is this your active investing strategy? So be really clear on that. Then think about, when do I want to access this money? Super is locked away until preservation age. Excuse me, while companies and trusts offer that greater liquidity and more flexibility about when you can use and access the wealth. So that's a really important consideration. Then looking at the tax treatment, no one likes paying too much tax. So compare those effective tax rates. If it's in super, it's 15%, but you've got the liquidity issues. Then company tax rates around that 25 to 30%. If it's in a trust and it's being distributed to individuals, well, then personal marginal tax rates might apply. So really just thinking that through. Then there's the complexity of actually administering this. Do you have the time, the inclination, the right advisors to get through all the accounting, legal, and compliance costs? And this is where who you need to consult is really important. So a financial advisor is an excellent person to consult in terms of just assessing the strategy behind your investment and the wealth accumulation, the cash flow impact. You need a great accountant or a tax advisor to model the different structures and ensure compliance. And then you also need a good advice from an estate planning or legal professional just to align the ownership with your long-term goals and legacy planning as well. So, and if you can get all three of those people talking, that's ideal, because you do want that collaborative, cohesive approach around your wealth creation.